The core promise of trading has always been simple: buy low, sell high. In the fast-paced world of cryptocurrency, this principle takes on a high-tech form known as arbitrage. At its heart, crypto arbitrage is the practice of exploiting price differences for the same digital asset across different markets. Imagine Bitcoin is trading for $100,000 on one exchange and $100,150 on another. An arbitrageur, or RB trader, would try to buy it on the first exchange and simultaneously sell it on the second. The goal is to pocket the $150 difference as a low-risk profit. This isn't a new concept. Traders have done this for centuries with stocks, commodities, and currencies. But in crypto, the game is faster, the opportunities are more frequent, and the technology is far more advanced. As of July 2025, the crypto landscape is more fragmented than ever before. We have hundreds of centralized exchanges, a sprawling universe of decentralized finance protocols, and countless tokens. This fragmentation is precisely what creates the price inefficiencies that arbitrage traders live for. A major news event in Asia might cause a price surge on a Korean exchange before its effects are fully felt on a US-based platform. A large trade on a decentralized exchange like Uniswap could temporarily push a token's price out of sync with its price on a major player like Binance. These small, fleeting windows of opportunity are where modern arbitrageurs make their money, turning market chaos into predictable, calculated gains. The appeal of this strategy is its perceived safety compared to speculative trading. Instead of betting on whether a coin's price will go up or down in the future, arbitrage is about capitalizing on a price difference that exists right now. It feels more like a science than a gamble. However, the simplicity of the idea hides a world of complexity. The profits on each trade are often razor-thin, sometimes mere fractions of a percent. This means traders must execute a high volume of trades to generate significant income. Success doesn't just depend on spotting an opportunity, it depends on acting on it faster than anyone else in a market that operates at the speed of light. This pursuit of speed and efficiency has transformed arbitrage from a manual task into a highly automated battle. In today's market, human traders clicking buttons stand little chance against sophisticated trading bots. These algorithms are designed to monitor thousands of trading pairs across dozens of venues simultaneously. They can detect a price discrepancy and execute the necessary buy and sell orders in milliseconds, far faster than any human could react. This technological arms race has raised the barrier to entry, making sophisticated software and powerful hardware essential for anyone looking to compete seriously in the arbitrage space. The game is no longer just about being smart, it's about being fast. The most straightforward strategy is cross-exchange arbitrage. This is the classic model: buying a cryptocurrency on exchange A, where the price is lower, and selling it on exchange B, where the price is higher. For example, if Ethereum costs $5,000 on Kraken but $5,015 on Coinbase, a trader would buy on Kraken and sell on Coinbase. The primary challenge here is speed and logistics. The trader needs to have funds ready on both exchanges to execute the trades instantly. Transferring the crypto from one exchange to the other is too slow. The price difference would likely disappear before the transaction is confirmed on the blockchain. Therefore, traders must hold both cash like US dollars and crypto like ETH on multiple platforms. A more complex method is triangular arbitrage. This strategy involves 3 different cryptocurrencies on a single exchange. It exploits price discrepancies between trading pairs. For instance, a trader might notice that they can trade their US dollars for Bitcoin, then trade that Bitcoin for Ethereum, and finally trade that Ethereum back into more US dollars than they started with. The entire loop happens on one exchange, which eliminates the need for slow cross-exchange transfers. The sequence might look like this: USD to BTC to ETH to USD. If the exchange rates between these pairs are slightly mispriced, the final amount of US dollars will be greater than the initial amount, securing a profit from the 3-legged trade. Then we have statistical arbitrage, a highly quantitative and model-driven approach. This strategy doesn't rely on simple price differences but on historical relationships and correlations between different crypto assets. Traders use complex mathematical models to identify assets that are temporarily behaving abnormally relative to each other. For example, if 2 tokens related to the same metaverse project usually move in price together, but one suddenly drops while the other stays flat, a statistical arbitrage bot might buy the underperforming one and sell the other. The bet is that their historical relationship will soon reassert itself, and their prices will converge again, allowing the trader to close both positions for a profit. Finally, the world of decentralized finance has given rise to DeFi and flash loan arbitrage. Flash loans are a unique DeFi feature that allows users to borrow millions of dollars worth of crypto with no upfront collateral, as long as the loan is repaid within the same single blockchain transaction. Arbitrageurs use these massive instant loans to execute enormous trades across decentralized exchanges. For instance, a trader could borrow $2 million in USDC via a flash loan, use it to buy a mispriced token on Uniswap, immediately sell that token for a profit on SushiSwap, and then repay the $2 million loan, all in one atomic transaction. The trader pockets the profit without ever having to risk their own capital. In the hyper-competitive arena of crypto arbitrage in 2025, the most crucial tool is the automated trading bot. These are not simple programs, they are highly sophisticated software systems designed for one purpose: speed. A human trader, no matter how skilled, simply cannot compete with a machine that can analyze thousands of data points and execute trades in under a millisecond. These bots connect directly to exchange APIs or application programming interfaces, allowing them to place and cancel orders programmatically. They are programmed with specific arbitrage strategies, such as cross-exchange or triangular, and run 24/7, tirelessly scanning the markets for fleeting profit opportunities that a human would inevitably miss while sleeping or blinking. Beyond raw speed, successful arbitrage relies on powerful data analytics and monitoring platforms. These tools aggregate real-time price feeds from hundreds of sources, including both centralized and decentralized exchanges. They provide traders with a comprehensive bird's-eye view of the entire market. A good dashboard will not only show current prices, but also calculate potential arbitrage spreads, factor in trading fees, and even estimate network congestion costs for on-chain transactions. This information is critical for making informed decisions. Without a clear and accurate picture of the market, a trader is essentially flying blind, unable to distinguish a real opportunity from one that will be eaten up by hidden costs. Another key tactic involves optimizing the underlying infrastructure. For serious arbitrageurs, every microsecond counts. This means they often invest in low-latency hardware and hosting solutions. Many will rent servers in data centers that are physically located as close as possible to the exchange's own servers. This practice, known as co-location, minimizes the physical distance that data has to travel, shaving precious milliseconds off of trade execution times. In a game where the fastest bot wins, having a superior network connection and faster processing power can be the deciding factor between securing a profit and seeing the opportunity vanish before your order is filled. Finally, traders must master the art of capital management and allocation. Arbitrage requires having funds readily available across multiple venues. A trader can't take advantage of a price gap between Binance and a DeFi protocol on Solana if all their capital is sitting on Coinbase. This means strategically distributing assets, both stablecoins and various cryptocurrencies, across different platforms and blockchains. This process itself carries risks, as it increases exposure to potential hacks or exchange failures. Therefore, sophisticated traders use risk management tools and strategies to decide how much capital to allocate to each venue, balancing the need for liquidity with the imperative to protect their assets from unforeseen events. While arbitrage seems like a safe bet, it is fraught with significant risks, the most prominent being execution and volatility risk. The crypto market is notoriously volatile, and prices can swing dramatically in seconds. An arbitrage opportunity that exists one moment might disappear the next. A trader might successfully execute the buy part of their trade, only to find that the price on the sell exchange has dropped before their second order can go through. This is known as slippage or a failed leg, and it can turn a potential profit into a sudden loss. The faster the bot and the lower the latency, the lower this risk, but it can never be eliminated entirely, especially during major market-moving events. Another major hurdle is the fierce competition. The secret of arbitrage is out, and the field is incredibly crowded. Traders are not just competing against a few other individuals, they are up against large, well-funded quantitative trading firms with teams of developers and massive server farms. These professional operations deploy the most advanced bots and infrastructure, making it exceedingly difficult for smaller retail traders to find and capture profitable spreads. As more competitors enter the market, the price differences shrink, and the profit margins become razor-thin. What was once a 1% spread might now be a 0.05% spread, requiring immense volume to be worthwhile. Security and regulatory risks also loom large over every arbitrageur. To execute trades, traders must grant their bots API access to their exchange accounts and connect their wallets to various DeFi protocols. This creates multiple points of failure: a bug in the bot's code, a vulnerability in a smart contract, or a security breach on an exchange could lead to a complete loss of funds. Furthermore, the regulatory landscape for crypto remains a complex and shifting patchwork. A sudden change in rules in a particular country could lead to an exchange freezing withdrawals or halting trading, trapping a trader's capital and preventing them from completing their arbitrage strategy. In conclusion, while crypto arbitrage in 2025 remains a fascinating and potentially profitable endeavor, it is far from easy money. The game is now dominated by high-frequency trading firms and their sophisticated ultra-fast bots. For the average person, the days of manually spotting and executing profitable trades are largely over. However, understanding the fundamental principles of arbitrage is more important than ever. It provides deep insight into market mechanics, liquidity, and the technological forces that shape crypto prices. Even if you're not running a bot yourself, knowing how the arbitrage game is played helps you become a smarter, more informed participant in the digital asset economy.